right, welcome back to TalkTickers. Today we're diving deep into Motorola Solutions.
That's right. We're unpacking their first quarter 2025 earnings call.
We've got the numbers, and our goal here is to, pull out what really matters for you, the experienced investor.
Cut through the noise, basically. Look at the key signals.
Exactly. So let's start with the headlines. How did they do overall?
Pretty strong start to the year, actually. Revenue was up 6%.
Okay, 6%.
Yeah, and that beat their own guidance. Growth across all three tech segments, too.
Nice. Any headwinds?
Yeah, FX was a bit of a drag, about $25 million, but acquisitions helped on the other side, added $32 million.
Got it. And profitability, always key. What are we seeing there?
Well, on a GAAP basis, operating earnings hit $582 million. That's 23% of sales.
Better than last year.
Yep, up from 21.7%. And the non-GAAP figures, which kind of smooth things out.
Right, the core operations view.
Exactly. Non-GAAP operating earnings were $716 million, up 12%. And the margin there, 28.3%.
Wow, that's a decent jump.
It is.
Yeah.
Up 160 basis points. They said it was higher sales, good product mix, and lower material costs.
But acquisitions took a bite.
Yeah, partially offset by acquisition expenses, as you'd expect.
So solid core performance. How did that flow down to earnings per share?
GAAP EPS was $2.53. Big swing from last year's loss. Remember they had that non-operating loss then?
Right, and non-GAAP.
$3.18. That's up 13% from $2.81 last year. Really shows the impact of those higher sales and margins.
Makes sense. Cash flow crucial, as always. What's the story?
Very healthy. Operating cash flow came in at $510 million.
Up significantly.
Yeah, $128 million higher year over year. And free cash flow, $473 million, so up $137 million.
Driven by?
Higher earnings, mostly, and better working capital management. Importantly, they stuck to their full-year target.
Which was?
Double-digit operating cash flow growth. They're still expecting around $2.7 billion for the year.
That consistency is definitely good to see. It sounds like they're putting that cash to work, too.
Oh, absolutely. Q1 saw $325 million in share buybacks, $182 million in dividends, and $37 million in CapEx.
And the acquisitions.
Right. They closed Rapid Deploy and Fee-attro. That was about $414 million combined. Shows confidence, strategic direction.
Definitely active capital allocation. Okay, let's talk backlog. That's a window into future revenue, right?
It is. Ending backlog was $14.1 billion.
That's just down.
It is, yeah. Down 2% year over year and about 4% from the previous quarter.
Oh, it's a drop.
Mostly strong shipments, especially LMR land mobile radio. And they recognized revenue from that big UK Home Office deal.
Okay. So execution, basically.
Exactly. But, and this is important, the software and services part of the backlog actually saw strong growth. So it kind of offsets some of that overall decline.
Interesting. So a mixed shift within the backlog. Let's dig into the segments then. Products and system integration first.
Sure. So products and SI sales were up 4% year over year. LMR was the main driver there.
Despite FX.
Despite a $14 million FX headwind, yeah. Operating earnings were $434 million. That's 28.1% of sales.
Margin expansion there, too.
Big time. Up from 24.8%. Again, higher sales, better mix, lower material costs. They also flagged some nice wins.
Like what?
A $19 million TETRA award in Germany, a $10 million fixed video order for Duke Energy, several P25 system orders, too.
But the backlog in this segment decreased.
It did, both year over year and sequentially, mostly because they shipped a lot of that LMR plus, typical Q1 order patterns.
Gotcha. Okay, so how about software and services? That's where the backlog growth was, you said.
Exactly. That segment really showed momentum. Revenue up 9% year over year.
Broad-based growth.
Yeah, across all three tech areas. Acquisitions added $32 million here. FX was a bit of a headwind again, about $11 million.
Lynn earnings.
$282 million operating earnings, or 28.7% of sales. Down just slightly from 29.8% last year, mainly due to integrating those acquisitions.
What were the highlights there?
Big renewals in LMR managed services, command center orders, fixed video service contracts, strong demand.
And the backlog, up year over year.
Significantly. Driven by strong demand for multi-year contracts. It did dip slightly sequentially, again, because recognizing that UK Home Office revenue.
Right. But the year-over-year growth really points towards that shift to recurring revenue, doesn't it?
Absolutely. That's often seen as a positive sign by the market. More predictable.
Makes sense. How did things look geographically?
North America was strong, up 9% revenue, growth across all technologies.
And international?
Down 3%, mostly FX, but also lower LMR revenue from Ukraine. video and command center grew internationally, though.
So a bit of a mixed picture globally.
Okay.
Looking forward then, what guidance did they give?
For Q2, they're expecting sales growth around 4%, non-GAAP EPS between $3.32 and $3.37.
And the full year, did they maintain guidance?
They did. Still expecting 5.5% revenue growth for the year, and non-GAAP EPS between $14.64 and $14.74.
Even with headwinds.
Yeah, that includes an estimated $40 million FX hit and potentially up to $100 million impact from tariffs.
Wow, $100 million from tariffs potentially.
Yeah, but they reaffirmed the guidance and also reaffirmed that double-digit operating cash flow growth for the year, the $2.7 billion figure.
So they must feel confident they can handle those tariff costs. How are they planning to do that?
They talked about proactive steps, adjustments in the supply chain, cost-saving measures, and looking at pricing opportunities.
Pricing power.
Some, yeah. But it sounded like cost reduction was the bigger part of the plan. Maintaining the guidance suggests they think these steps will work.
Okay. Any interesting new products or initiatives they talked about?
Oh, yeah. Big focus on two new technologies, SVX and Assist.
Okay.
They integrate with their Apex Next radio platform. SVX is a video remote speaker mic for P25 radios. Combines secure voice, video, AI.
So less gear for officers to carry.
Potentially, yeah. And Assist is their AI platform. Gives real-time info to first responders.
AI seems to be everywhere. How's the interest?
Apparently, very strong early interest from public safety. They see it driving adoption of their higher-end radios and software.
Sounds like a big bet on that convergence of voice, video, and AI in their ecosystem.
Definitely. And it ties into that software push we talked about.
Right, more than just a side business now.
For sure. They stressed ongoing investment in software, driving cloud, and SaaS adoption. That means more recurring revenue.
Which investors usually like.
Exactly. More stability. The Apex Next platform with app subscriptions is key there. They expect over 200,000 devices in North America by year-end.
Generating decent recurring revenue per device.
Yeah, they said an average of $300 per device annually.
Interesting. Anything else stand out?
They renewed their credit facility, $2.25 billion, so continued financial flexibility. Right. They also mentioned demand from the U.S. federal government is still strong.
Even with budget uncertainties.
Apparently so. And state and local budgets look healthy, with public safety tech still a priority.
You mentioned the SVX mic. Did they talk about the tech behind it and the AI partnerships?
We did. They highlighted the audio quality, linking it to their decades of experience in AI noise cancellation.
Makes sense for public safety.
And for the Assist AI, they're partnering with Anthropic's Claude, emphasizing safety and domain knowledge, which is critical there.
Responsible AI, basically.
Seems to be the focus. They also mentioned a partnership with Brink for drone as a first responder tech, expanding capabilities, potential integration down the line.
So despite that slight backlog dip overall, the tone felt pretty positive. Strategic progress.
I'd say so, yeah. They were clear the backlog dip was about execution, strong shipments, that UK contract. Underlying demand seems solid. They still expect product orders to grow for the full year.
And the tariff mitigation sounds like a multi-pronged approach.
Right. Some pricing, but mainly cost reductions. And they really hammered home the AI innovation, especially this is in the command center. They see it fundamentally changing how people use their systems.
Creating cross-selling opportunities too, presumably.
Exactly. And potentially driving bigger tech budgets in public safety overall.
Okay, fascinating stuff. Let's shift gears now to our This Is Not Financial Advice segment. Based on all this, what's an outrageous but plausible trade idea?
Well, building on that AI theme, Motorola's clearly pushing hard on AI analytics for public safety with Assist and pulling data from devices like SVX.
Right.
So here's a thought. Consider looking at companies specializing in edge computing infrastructure. Specifically, secure edge computing built for processing real-time video and audio screens from these public safety devices.
Okay, so not Motorola itself, but the tech supporting their vision.
Exactly. Think about all that data from body cams, car systems, drones. It needs to be processed quickly, securely, often right there near the source, not just in the cloud. Low latency is critical.
Makes sense for real-time analysis.
Right. So as AI like Assist becomes more integrated, the demand for that specialized, robust, secure edge infrastructure could really surge. While MSI develops the apps and AI models, the companies providing the underlying pipes and local processing power might benefit significantly.
Interesting angle, focusing on the enablers.
Yeah. It's definitely speculative, of course. Depends on continued AI adoption, budget priorities, and the need for this specific kind of infrastructure. But it's plausible, right?
Outrageous, but plausible. Fits the bill. Okay, that wraps up our deep dive into the Motorola Solutions Q1 earnings call.
We covered a lot: the numbers, the strategies, the new tech, the outlook.
Hopefully this gave you a clearer picture of where they stand and where they might be heading. What stood out most to you? Always good to reflect.
Definitely.
And just a reminder, this discussion was for informational purposes. It's not investment advice. Always do your own homework.
Absolutely. Thorough research is key.
Thanks for tuning into this deep dive. We'll catch you next time for another earnings call breakdown.